Hello and welcome. I'm Mark Wilson, E&P and Oil Service Analyst for Jefferies, and I'm delighted to welcome you to this discussion and Q&A today with Mike Nicholson, CEO of International Petroleum Corporation. Now, stock performance of IPCO over the past year has been remarkable and built on the corporate and operational progress of the company since spin-out from Lundin Energy in 2017. And Mike will take us through the company's delivery and forward strategy in just a moment. And before we move on to Q&A. But first, as today's call is being recorded, I do have to read this disclaimer. Members of the media and press are not authorized to be on this call. If you are from the media or press, please disconnect from the call now. The content presented on this conference call is proprietary to and or subject to the copyrights of Jefferies or third parties. And further, as a matter of legal compliance, we remind you, you must not attempt to elicit from any speaker at this event any material, non-public information or other confidential information. And accordingly, the speaker may decline to respond to any question in his or her sole discretion. You may not publish or otherwise publicly disclose the name of or otherwise identify the speakers unless Jefferies permits it in writing. And by attending this event, you agree to all of these restrictions. And now, with that out of the way, let's turn over to you, Mike, for an introduction. Thank you.
Okay, a very good afternoon to everybody, and thank you, Mark, and to the Jefferies team for hosting the discussion this afternoon. As Mark said, my name is Mike Nicholson. I've been the CEO of IPC since 2017, and happy to walk you through a few slides to talk about the journey that we've had since the spin-off from Lundin Energy back in 2017. So if we go to the first slide, before I get into the slides, maybe just worth taking a moment to talk about the rationale and why we took the decision to spin the non-Norwegian assets out of Lundin Energy. The asset platform that we had was in Malaysia and France and Netherlands, and we felt that it was a really good point in the cycle to spin the non-Norwegian producing assets out of the company debt-free and use the cyclical weakness to create a new internationally focused upstream E&P company to take advantage and aggregate a resource base to position ourselves and our shareholders for the next cyclical upswing. And that's exactly what we've done. And if we look at this first slide, since the 4 acquisitions that we've made in the last 4 years, we've materially increased our production. On average now, if we just develop the 2P reserves that we've amassed, we can keep production essentially flat at around 45,000 barrels a day over the next 5 years. And if you look at what that can deliver in terms of free cash flow to our shareholders between $55 Brent and $65 Brent, you're looking at somewhere between $600 million and $900 million of free cash flow. You can see that for every $10 a barrel, there's about an extra $300 million of free cash flow. So at today's $75 oil prices, you'd be looking at somewhere closer to in excess of $1.2 billion of free cash flow. And to put that in context, today, IPC's enterprise value is around $1 billion. So we can pay off every single dollar of debt and buy back every single share and still be left with a couple of $100 million at today's oil prices. So of course, that puts us in a very strong position to return value to our stakeholders. Our immediate priority is debt reduction. And company has had a history of buying back shares since 2017, and of course with these kind of free cash flow levels, that retains quite significant headroom to be able to undertake that in the years ahead. M&A has been a big part of our story, and of course we still see huge opportunities in the energy transition as the majors seek to sell off the smaller, less material assets in their portfolio. And I'll touch upon it in one of the slides, organic growth. We started life with no contingent resources, and now we've got a portfolio in excess of 1 billion barrels. So lots of option value, if you like, in the non-2P reserves category within the IPC portfolio. Turning to the production guidance, we've grown quite quickly from our beginnings back in 2017 of 10,000 barrels a day. We've more than quadrupled our production. Our initial guidance that we gave the full year 2021 back in February was 41 to 43,000 barrels a day. We had an exceptional delivery across all the assets in Q1, so we were running just below 44,000 barrels a day for the first quarter. And the fact that we acquired an additional 25% interest in our Bertam field in early April, and our investment program to bring on some additional production from our Onion Lake thermal facility means that we feel confident that we're going to be producing towards the high end of that full year guidance range of 43,000 barrels a day. And with those production adds, we should certainly be exiting the year in excess of that 43,000 barrels per day. In terms of our cash flow performance, it was also significantly ahead of our February guidance. If we look at the first quarter operating cash flow generation, when Brent prices were just above $60 per barrel, we generated just under $70 million of OCF. And that was almost a third of our full year OCF forecast, assuming a Brent price of $65. And the reason we were ahead of guidance was production was above the top end of the guidance range, gas prices were strong, and Canadian crude price differentials were much tighter than the $17 a barrel that we were assuming. So all of those factors combined give us a very strong first quarter result. And I think when you look ahead into the second quarter, we've seen continued strength in the benchmark prices and gas prices and in differentials. So that trend should continue through the second quarter. We set a pretty limited capital expenditure budget, fully funded at $40 per barrel Brent, and $37 million for the full year. So when you put that together, of course, on the next slide, what that shows is IPC's set up to generate some pretty significant free cash flow for the full year 2021. First quarter alone was just under $50 million. Our high side free cash flow guidance at 65 Brent for the full year was $155 million on the high side. So we're about a third of the way of meeting that high side guidance already, just after the first quarter performance. And again, that's because we've seen tighter Canadian differentials and strong benchmarks. And just to give a feeling of the sensitivity, for every $5 improvement in Canadian differentials, it feeds through to add about $30 million of free cash flow. So if you're going to run 65 long term with tight differentials that we've seen, you could be looking at up to $180 million plus in free cash flow based upon the guidance that we've already provided. In terms of the reserve journey, it's been quite a significant growth profile in a relatively short period of time. We started life with 29 million barrels of 2P, an 8-year reserve life. And through the 3 acquisitions, Suffield, Black Pearl, and Granite, we've been able to increase our 2P reserves 9-fold. And more importantly, we've been able to extend the longevity of our reserve life to now 18 years. It's highly developed. 60% of our 2P reserves are classed as developed. It means that the capital expenditure to maintain the 45,000 barrels a day over the next 5 years is relatively low, $4.50 per barrel of maintenance capex. So it's a low decline, high value reserve base that we've managed to aggregate. In terms of the contingent resources, material portfolio in excess of 1 billion barrels. The biggest single contingent resource that we have on our books is our Blackrod project in the Athabasca Oil Sands region in northern Alberta. We have been doing a lot of work to continue to mature that project. We've got a pilot that's been running for 12 months. We've been using the latest drilling technology to try and improve the efficiency and the productivity of the wells on that project. And of course, with higher oil prices and tighter differentials, we can start to unlock some option value in that project through the work that we've been undertaking this past year. So again, when we pull all that together and just come back to the cash flow generation, I think it's important to show that the numbers, whether it's 55 or 65 and $600 to $900 million of free cash flow, that these really are anchored in reality. If you look at our 4-year history, production on average has been about 33,000 barrels a day as we've grown. Average oil prices over the last 4 years have been around $58 per barrel. And we've been able to generate $400 million in free cash flow over that last 4 years. So when we look ahead to the next 5 years, with average production up in the 45,000 barrels per day range, you can see that those free cash flow forecasts should be highly achievable. And if we also look at IPC through the value lens, this is the valuation just of our 2P only reserves, so just the 270 million barrels of reserves, no value assigned to any of our contingent resources. And we run this on our year-end reserve auditor's price deck, which was $48 a barrel for this year, rising to $57 per barrel by 2025. So fairly conservative oil price deck relative to where we see oil prices today. And that gives you a net asset value of just over $1.3 billion or 70 SEK a share. And based upon our end May share price of 35 SEK per share, that represents about a 50% discount to our NAV. If we look at price decks 12 months ago, which were closer to where oil prices are today in 2025, the share price would be close to, the NAV per share would be closer to 110 SEK a share. So I think there is room as we come to the year end, and if auditors increase their price decks to see that NAV per share grow materially. And finally, as well as our journey to aggregate a significant resource base, it's also become increasingly important to have a very clear strategy with respect to ESG. And I think we've done a very good job. If you look at the assets, all the acquisitions we made have been in Canada. The Canadian average CO2 intensity of a barrel produced is just under 60 kilograms per BOE, and 80% of our production is in Canada. So we're already ahead of the pack by being 1/3 below the emissions intensity. And what we've made a commitment to do over the first 5 years is to further reduce that through a combination of operational emissions reductions and carbon offsetting to bring that down by a further 50% to 20 kilograms per BO2 following the offsetting program. We've also, last year, alongside our third quarter results, we took a step change in our non-financial disclosures. We released our first sustainability report. We'll be publishing shortly our second sustainability report, and it will be fully GRI compliant when we release that later this year. And that last year's report set the baseline, and it's going to be an important line in the sand to show the progress that we've been making over the last 12 months. So that concludes the highlights. I think it's been a busy period. We've grown quite significantly in the last 4 years, and I think IPC's got a very bright future ahead of us. So I'll hand the call now back to Mark.
Oh, great, Mike. Thank you very much. And indeed, those last 4 years, as you've shown, significant production growth, 4 times higher than from the spin out of Lundin as it was, Lundin Petroleum, now Lundin Energy, reserves 9 times higher. And particularly from all these acquisitions and operational improvement in Canada. So I'd like first to, is this how you would have envisaged it 4 years ago? Was this the type of growth you were looking for? And what actually led you to the geography of Canada, first off? And then secondly, you show an average production, you can maintain 45, you think, over the next 5 years versus an average of 33. But is that actually the ambition? What is the next 4 years? What should they bring in terms of strategy? Would you see the same levels of growth again? And what about the geography of that growth?
Okay, no, great questions, Mark. And yeah, I guess the short answer is it would probably be no. I wouldn't have expected the growth on day one. I mean, we were in a very fortunate position that the mandate was global. And if you look at the success of any of the companies within the Lundin Group, it always starts with asset quality. And I think the Lundin family are famous for taking bold, contrarian moves and have created huge amounts of value by cleverly interpreting the cycles and taking advantage of those. So the reason we actually ended up with our first acquisition in Canada was exactly that situation. We'd just come out of the oil price collapse in early 2016. A lot of companies' balance sheets were extremely stressed. In Canada, a lot of the majors were exiting. The Canadian market, Shell were selling, Statoil, Equinor were selling, Marathon were selling. So Synovus were disposing of assets. So you had an environment where there was lots of quality assets coming to the market, but the sector was suffering from an overhang of too much debt on the back of the price collapse in early 2016. So really for us as a debt-free company, we were looking at good quality assets, stable jurisdiction, low tax regime, little competition, and lots of quality people that you could pick up and establish a team. So it was really that combination of factors and that dynamic. And probably the most important single thing also in Canada was the whole egress situation was broken. Production had gotten ahead of available export capacity. So you had a situation of extremely volatile Canadian crude price differentials, which meant that asset prices were extremely stressed. So we took the view that that's not sustainable. The Canadian government were effectively subsidizing US refiners to the tune of $80 million a day through wide differentials, and we felt that the pipelines would have to be built, and buying in that cyclical low and position ourselves for recovery was kind of one of those contrarian calls we made to go into Canada. And I think we see now with Enbridge coming online and Trans Mountain being built that dynamic is starting to play out, and we're starting to see much tighter differentials. So that was really the thought process as to where and why we went to Canada. Of course, Canadian banks provide acquisition financing as well. So it's also obviously positive in terms of not having to raise too much equity as well to fund that growth. In terms of your question about what's next, and I'd be very disappointed if all we do is 45,000 barrels a day on average over the next 5 years. I mean, we made an acquisition every year. I think it's in our DNA to still be opportunistic and look for value accretive acquisitions, and the same mandate applies. It starts with asset quality. We're not wedded to Canada as a jurisdiction, and I think that with the energy transition, that dynamic we saw in Canada, I think is certainly picking up pace internationally as the majors look to transition and increase their investments in renewable energy and start to dispose of some of their non-core assets. So I think there's going to be a big opportunity for companies like IPC to play a role in acquiring some of those assets from the majors in the years ahead.
And that is it's very interesting talking about Canada and being in a cyclical low, for instance, where we fast forward to where we are today, balance sheets are clearly improving across the board with the commodity price. But to your point, majors are still looking to dispose. Are there any particular geographies that look, for instance, more attractive or potentially challenged in a structural way, and why would that be?
Yeah, I think there. I mean, I haven't seen that kind of same dynamic that we saw in the Canadian market, but I think there are still, when we look internationally, the kinds of jurisdictions that we're looking at would be still those that the commercial banks would follow, because clearly I think a lot of the companies in the energy space are still trading at a huge discount to let's say the fair value of their assets. So of course it does make it more challenging to raise equity. So I think when we're looking at jurisdictions that we'd like to move into are those where the commercial banks will still follow. So still some perhaps less risky jurisdictions internationally.
Okay, and so in terms of your existing you went into Canada and expanded in Canada. Your other international locations will be France and Malaysia. Would you see? I mean, certainly picking out Malaysia, we've seen assets on the table there. There are large majors involved in Malaysia. Would you see that as a region of expansion?
I mean, we've got a phenomenal team on the ground in Malaysia. I mean, our Bertam project has been a real success story. We've produced well in excess of the original 2P. We're trending now above the 3P case on sanction, and uptime has been above 99% on average since the field started in May 2015. So we've got a phenomenal team on the ground, so we can leverage that and make acquisitions, and then of course we'll play a role in that. And I think you're right, there are going to be more disposals coming on the market, and it does make sense for us to look at those as they come to market. Okay.
So now turning back to your cash flow story, which is very strong this year, and in terms of leverage and shareholder returns, let's just talk about those and what is the point you're trying to get to, if indeed there is a point, to say restart dividends or buybacks, and what leverage position are you at, and where do you think you'll be able to get to?
Yeah, I mean, by the end of last year, we were close to 3 times debt to EBITDA. So that was obviously on the back of the pandemic. That was higher than we had hoped for, with oil prices just above $40 per barrel last year. So one of our top priorities, we've been very clear about that for this year, is to deleverage. And we're off to a great start. After the first quarter, our leverage was already down to 1.8 times. And if you annualized our Q1 EBITDA, would be closer to 1.1 times. But I think we'd like to see the money in the bank and the debt levels down in absolute terms, rather than forecasting that's going to be the case over the next 9 months. So on the current trend, if oil prices stay at these levels, and we're generating well in excess of the high-end free cash flow guidance of $150 million plus, then we'll be well below 1 times net debt to EBITDA by the end of this year. And that was the levels we were at when we launched our last share repurchase program, which was in late 2019.
And how do you view, or what is the feedback internally between buybacks and or dividends? Is there any difference that the board sees that?
Yeah, I mean, it's been a bit too early for us to come up with a firm position on that right now. I think given it's not likely to happen until later in the year, clearly one of the most important things will be where is the stock trading at that point in time relative to where we see fair value. So I think that assessment in terms of the allocation will be made later in the year. But I think it is fair to say since our inception, all we've done so far is buybacks. We've bought back close to 33 million shares, or in excess of 20% of our shares outstanding. So we have been certainly pretty active on the buyback front.
Okay. All right, very good. So then let's talk about this this NAV discount. You've always shown the NAV valuation, and even now talking about the 50% discount. You mentioned the oil prices that go into it. What else do you think goes into it that generates the? Is it either the premium or what the market is holding back from not recognizing in the discount that it's applying? 1.3 billion NAV versus, or 70 krona versus 35, give or take, out there in the market. What do you feel is being missed?
I think it's in part still a huge volume of generalist investors that are still not participating in the energy space, and I think when we took that decision to start acquiring resources in Canada, companies were trading at a much wider discount to that. I mean, it was in excess of 70%. So when we were buying assets in companies, there was that disconnect in where we saw fair value relative to what we're having to pay to acquire assets. So I think we've always been realistic that the value compression was never going to happen overnight. I think one of the big things was the uncertainty of the egress situation and the volatility around differentials. I think when Line 3 is up and running in Q4 of this year, you've then really got some solid fundamentals to show that volatility or that risk factor or risk premium perhaps that you had in Canada has now gone. And with Trans Mountain coming and another 700,000 barrels a day of capacity in late 2022, I think you've now got a forward look over the next 5 years that gives much more confidence in that Canadian crude price that we haven't seen for the last 6 years. So my sense is going to be a combination of people actually seeing that in the rear view mirror, and also a return of generalist investors to the sector, because that's ultimately going to be required, I think, before we see valuations compress a bit more.
Got it. Okay, and this also touches on something I think is very important. Over here in Europe, we are physically a long way from Alberta and the way the oil market and gas market works over there. So I think it'd be worth spending a bit of time for investors just explaining this, what egress means for Alberta crude, and in terms of export to refineries in the USA, it feels like. So an Enbridge Line 3 and Trans Mountain. Just put that into context for the layman, please.
Yeah. Do you have can you share the slide? It's probably easier if I refer to a slide, because it's something that we've been talking about for the last couple of years. Can you see the screen, Mark?
Not yet.
Okay. Can you see the screen, Mark?
I can indeed, yes.
Yeah. So this is probably as simple as we can split and explain it in one picture. And if you look at the chart on the right-hand side, the grey area, if you like, has been available pipeline capacity and refinery demand. And the red line is Canadian crude production. So if you look back from over the last 5 years, you can see that the red line has been above the grey area. So that means there hasn't been enough either refinery demand or export pipeline capacity to clear Canadian crude from the local market. And that's created artificially wide differentials from the WTI to the WCS. And in late 2018, when one of the main pipelines had to shut in temporarily, differentials went as wide as $50 per barrel. So obviously that was a huge amount of volatility. Now, if you look at, I mentioned Enbridge Line 3 which is the bar in orange, 370,000 barrels a day of additional pipeline capacity is coming on stream from Alberta to the US Midwest. And you can see that for the first time in 5 years, available demand and egress is going to be above the red line, which is Canadian crude supply. And then Trans Mountain, which is due to be completed by the end of 2022, that's a pipeline that's running from Edmonton to Vancouver, which is going to be able to serve US West Coast markets and Asian markets. Another just under 600,000 barrels a day of available pipeline capacity. So you can see now in the next couple of years, you're going to have more than 1 million barrels a day of surplus capacity, which means that Canadian crude prices should be driven off the fundamentals of how much it costs to transport that crude by pipeline to demand centres down in the US Gulf Coast, and that's around $13 per barrel. And if you look at forward markets for 2022 and 2023, that's exactly where differentials are pricing right now, around those pipeline differentials of $13 per barrel. So I think, you know, the market's certainly seeing this infrastructure going in the ground, which should put a much firmer fundamental basis under Canadian crude pricing.
Okay, and is there any bigger impact here for the large pipeline that was going to be put down the US that has been delayed again or even cancelled?
Yeah, I mean that would, I think that's Keystone XL was obviously a project that was being supported by the Trump administration. You can, if you look at the market balances there, with already 1 million barrels a day of excess capacity, you know, you can see there isn't really the need for a Keystone XL pipeline today. So that doesn't sit in any of these forecasts. And I think with 1 million barrels of spare capacity, there's more than enough egress for you know, for at least the next 5 to 10 years.
Got it. Okay, and so just remind us again, what would you expect differentials to be out, let's say in 24, 25, after the Trans Mountain comes on stream?
Well, it's an interesting question. I mean, it's right now the 12 to 13 is based off fundamentals of US Gulf Coast economics. So you've got roughly around $6-7 a barrel for quality to get from WCS to WTI, and around $6 per barrel for transportation costs to get to the Gulf Coast. I think that's our long-term view. That's what sits in our reserve auditor forecasts and in our NAV calculation. I did read from one research report, it was a kind of interesting thesis that with the significant drop-off with the sanctions on Venezuelan crude and the large refinery that's been built domestically in Mexico, means that in Mexican Maya grade is very similar to WCS, that there's an expectation that Mexican heavy oil exports are going to drop by between 50 to 70% over the next 2 years. So, you know, if that happens and there's a tightness on the Gulf Coast for heavy oil, you may actually find a scenario where the marginal pricing point goes from the Gulf Coast to PADD 2 refineries up in the Midwest, and, you know, theoretically pipeline or crude differentials could drop to below $10 a barrel. But I wouldn't say that's a widespread held view right now, but it's going to be an interesting dynamic to watch.
And worth talking about right now. That's very interesting, Mike. Let's touch on the gas market there as well, because that seems to be recovering quite well. But also I'd like to specifically ask, we tend to talk about cold weather impacts over in Canada. At the moment, we're seeing news of incredible hot weather, and obviously some stories on how that is impacting people's lives, etc. But in terms of what that's doing to the market, one imagines is driving up the price quite significantly.
No, that's absolutely right, Mark. And I mean, we've always been pretty conservative on our outlook for gas. In our our CMD forecast for this year, we were assuming average gas prices of $2.50 per MCF. Taking account, we had hedged some of our volumes for the first half at $3, so those were factored in. But you're absolutely right. I mean, see with the fall off in US shale production, in combination with that, what that's meant is there's been a drop off in associated gas production also in North America. And with the weak gas prices we've seen in Canada over the last few years, there has been a lack of investment in further supply expansion. So as you say, there was a fairly cold winter this year. It wasn't as long and as deep as we've seen in the last couple of years, but it meant that storage levels were certainly not above the 5-year average. And with the drop-off in US shale production and associated gas and the higher than average temperatures, what we're actually seeing is storage levels are now down at the bottom end of their 5-year average. So things are incredibly tight, as you referred to. And what we're seeing now is, with a particular hot spell, Canadian gas prices today are well in excess of $4 per MCF. And if you look at the forward market for Q4 and for Q1 next year, prices are certainly in the high threes, approaching $4 per MCF. And I think that's going to be an interesting one to watch, because usually at this point, the seasonal trend is you're injecting into storage to provide a buffer for winter when winter is cold. So it's going to be an interesting dynamic that if you're below the 5-year norms and we do have a cold winter, then there could be some pretty challenging situation in terms of supply and pricing. So I think things haven't been this bullish on gas pricing for a long time.
Wow, very interesting. And then on the ground, just to touch on some of the assets you have there, in particular the main gas field is your Suffield asset, but also oil production out of Suffield has come on very strongly after the low levels in 2020 and the COVID levels. What do you put that down to? Is that almost flush production coming back, or is that sustainable at Suffield?
Yeah, I mean, it's a classic combination of an asset that wasn't being worked in the hands of a major and a smaller company taking over operatorship and deploying some capital and using the team that have worked these assets for many years to tap into their expertise and put forward some development projects. So if we look at the Suffield oil slide, I'll just ask Rebecca to share the screen for a second. But we took over operatorship of the assets at the beginning of 2018 when we closed the acquisition. And if you look at the trend, this is a low decline asset. So if you're not investing, it's declining about 10% per annum. And Cenovus, who was the previous owner, hadn't drilled any oil wells for 4 years before we acquired the property. We took over operatorship, you can see at the beginning of 2018, and we had a rig already operating by the fourth quarter of 2018, and we continued with a 1-rig program all the way through 2019. And the biggest single project that we did is an enhanced oil recovery project called, on one of our pools called N2N. And that's essentially, it's an alkaline surfactant polymer flood. The simple way is, if you imagine a sponge, it's a bit like adding soapy liquid to release more oil from the pore space within the sponge in the subsurface. And we're seeing the fruits of those investments that we made back in 2018 and 2019. The blue chart on the top of the slide shows the ramp up in production following the ASP flood that we started. And the investment case was the red line, and you can see the hard blue line with the temporary shutdown for COVID is running well ahead of that investment case. forecast. So yeah, we've seen production climb from around 6,500 barrels a day when we took over operatorship to in excess of 8,000 barrels a day. So it's really just putting our best people and a bit of capital on an asset and moving forward with some low risk developments.
That's that's very good delivery. And if you leave the slides up there, actually, I think Rebecca, I think there's two areas. We've got 10 minutes left on this call. And I think there's two areas I want to touch on in the time we've got left. One is Blackrod, almost 1 billion barrels of contingent resources. What do you need to see there? What is the progress from the current pilot projects, and how can you move forward such a large development? And the second point is the ESG element, particularly on emissions. You've been very open and clear with your sustainability reports and your CO2 emission levels. You speak of reducing them by 50% over the next few years. So taking us through the steps of how you can move what is about 40 kilograms per CO2 down towards the world average of 20 that you show. Those are two areas I think are very interesting to discuss.
Yeah, so if we start with Blackrod, this came into the IPC portfolio with the acquisition of Black Pearl resources, and it was a classic situation where the 2P basis was trading at a significant discount to fair value, and you could pick up a significant contingent resource without having to assign any value to that. And it's, for us, it created a huge amount of option value, if you like, because a huge amount of time and effort has gone into maturing this property before we combined with Black Pearl. There've been about 180 million Canadian dollars invested in the property through the drill, acquiring 3D seismic, through drilling appraisal wells, through 2 phases of pilot well testing. So really what we did when we came into this was, we had a look around at what other operators were doing and what best practices, technology had moved on. So we decided to deploy the latest drilling technology, which is, essentially drilling longer horizontal wells. The previous pilot was around 950 meters, and we extended that to 1.4 kilometers. And we fitted the pilot producer with a steam flow control device. So when we're injecting steam across the full length from the heel to the toe of that well, we can optimize the amount of heat that we put into the reservoir, which can also reduce costs. And really the idea there is if you've got a large, pool of oil to drain, if you can do it with a smaller number of wells from a smaller footprint, then you can get the costs down, provided the productivity and the production uplift comes. And I think the early results that you can see from the chart on the slide are showing that. You can see at this point in time in the ramp up of the second well pair is producing around 400 barrels per day, and we've been producing well pair 3 in excess of 700 barrels a day. And we have hopes that can increase to above 800 barrels a day over the next few months. So really, hard data that we can then tie to type curves, and we can roll that through simulation that can then feed into how does the full field development for a phase 1 look like, and really get the break-even costs for this project down. I think previously when Chris and the team were looking at well pair 2, they were talking about an all-in break-even price of around $55 per barrel WTI. So we can get costs down 10 to 15%. Perhaps we can push that break-even down towards the $50 per barrel WTI level. And I think the thing that differentiates this project is, phase 1 is shovel ready. All the permitting, the environmental permitting is in place. All the construction permits are in place. Phase 1 is 20,000 barrels a day plant capacity, which would drain around 180 million barrels of 2C resources. It used to previously be classed as 2P reserves on Black Pearl's books, but because under the securities exchange rules, if you don't move forward with an investment decision within 5 years, then you can't classify that as 2P. So, so it's a very mature project. It would take 24 months from construction to first oil. Linking back to the discussions on differentials, you wouldn't really want to be going ahead with a major investment decision if you've got blowouts in Canadian crude price differentials. So, we've proved up the productivity on the subsurface side, and with more market certainty in terms of Canadian crude pricing, I think those two things combine to start to bring some option value to this project. So bit more work to do and see, get into those plateau production rates, but certainly very encouraging so far. On the ESG side, we have made that commitment to reduce our net emissions intensity by 50%. We'll do as much as we can with our facilities to look to make those more efficient. We've invested a huge amount into our heat exchangers to capture as much energy as we can from our production facilities at Onion Lake Thermal. And that reduced our emissions intensity by around 100,000 tonnes a year. On our Bertam project, we invested in dual fuel power generation that allowed us to capture the gas that comes off the separator. Instead of flaring that gas and buying diesel to run power generation, we can use that gas to generate our own power to run our electrical submersible pumps, and that reduced our CO2 intensity by about 50,000 tonnes. So wherever we can operationally, we'll make investments to reduce our footprint, and where we can, we'll go into the voluntary offset market and acquire carbon offsets to bring ourselves down to that global industry target of 20 kilograms per BOE. And what we've done is we've partnered with an expert, which is First Climate, that effectively act as a clearinghouse, and they go and source projects. They find projects that are net long their carbon emissions, and we buy those surplus credits through First Climate, and we have a say in the projects that we can invest in. So that's really been the IPC approach.
Do you think the market and investors, if you like, are getting consistent numbers in terms of companies' emissions when reported, or do you think there's a variance to what people classify?
Yeah, no, I think the standard in our sustainability report, we report our Scope 1, Scope 2 and Scope 3 emissions. Most companies' targets are set on reducing their Scope 1 emissions. So I think we're pretty consistent with the reduction targets that we see across the broader sector.
Okay, and then 2 points to finish on this point. What is the carbon tax implications to IPC today? Do you pay a carbon tax in Canada? Is there such a thing, or is there legislation planned? And then secondly, are these kind of ESG and emission elements, are they part of M&A filters that you do these days?
Absolutely. On the second question, so we don't look at any asset acquisition without making an assessment of how that's going to impact our carbon intensity. So and what would be our approach to make sure that it doesn't knock us off track in achieving those targets. So that's fully integrated in our M&A evaluation approach. And the first question was
is on carbon tax. I'm always fascinated to hear what companies actually pay on carbon tax.
On carbon tax. So in Canada, there's no carbon tax in France or Malaysia, so we don't pay any carbon tax there. There is a carbon tax in Canada. It's currently 50 Canadian dollars per tonne, and it's forecast to rise to 170 Canadian dollars per tonne by 2035. So when we look at how that translates in terms of cost, if you like, per barrel over that period, What we would see is our kind of overall cost increasing from around 30 cents per BOE to around $1.30 Canadian per BOE by 2035.
Got it. Okay. That's very interesting to find. I'm fascinated to hear there's no carbon tax in France. Is there an EU overall level coming?
Not that we've seen. Not that we've seen that thus far. So please don't tell the French authorities that.
Well, very good. Well, I think we've covered a lot of ground today. It is, goodness me, it is exactly on 50 minutes. So I thank you so much for your time, Mike, and Rebecca as well. And thank you, IPC, for spending the time and doing this. I think it's been very helpful. For anyone watching this or the replay, and if you want further information, either through ourselves, we can put you in touch with Mike and the team. But thank you for your time today.
Thank you very much, Mark, and thank you to the Jefferies team for hosting today.
Okay.